Federal Open Markets Committee meeting revealed that the Fed members are considering tapering their asset purchasing program. The U.S. Federal Reserve might reduce the $40 billion monthly purchase of mortgage-backed securities. It sent many investors into panic, causing them to liquidate many of their assets. Tapering is when the central bank slows down their accumulation of new assets on its balance sheet. This can mean the Fed is winding down or completely withdrawing from the monetary stimulus program. Investors don't like that because that means the Fed will reduce the $120 billion or so bonds that they buy. This is also referred to in a lot of places as quantitative easing. Obviously, when there are less investments made, the value of assets go down since the demand goes down. The last time the Fed tapered was 2013. However, the circumstances are different. Bloomberg's Bill Dudley offers some valuable insights. In 2013, the Fed had little experience with winding down an asset purchase program. That left the market participants uncertain about the timing and sequencing the transition to a world with no asset purchases and also higher interest rates. Now Fed officials have the experience in 2013, and they're better able to determine the steps needed to help the economy recover. Second thing to think about is this is a long-term program. Assuming that the economic outlook doesn't change much, it's probably about 6 months away before they taper. They said that they won't start tapering until inflation is around 2%. And that's 2% by their calculation. Even with a strong economy, that's going to take some time. Third thing to consider, the economy is still far from full employment. Specifically 7.6 million jobs short from where it was prior to the pandemic. Even with the gains of 1 million jobs per month, achieving substantial further progress would take several months. Fourth thing to consider is $80 billion in treasury securities and $40 billion in mortgage-backed securities every month will be eased out, not killed in a month or two. If, for example, the central bank cut purchases of both the treasury and mortgage-backed securities by $10 billion per month, and each policymaking meeting, mortgage-backed securities could potentially reach zero after 4 meetings, compared with 8 meetings for the treasury. Just keep in mind that this tapering is a good sign. Every dollar the U.S. uses to buy assets right now is coming right out of the printing press, so to speak. So if they can control their spending, they'll have fewer reasons to print money, which should slow down inflation. Operative word is fewer reasons. They could still continue printing money for whatever reason. Money is just one aspect of the economy, so this is something we have to look at. Tapering doesn't address the fundamental problems of our economy and our financial system, which is jobs, products, and basically policies. It only means that inflation is here to stay. Cashing out of your investment is the worst thing you can do to kind of thrive through this inflation period. What you need to do is invest more and seek guidance from professional advisors and see how you can adjust your portfolio to accommodate for more economic turmoil. Just make sure you got some kind of hedge, an asset that will remain stable when everything goes south. Gold is a great hedge, and we can help you out with that.
If you're interested in investing in precious metals and you want to talk to a no-hassle representative that has experience in physical metal, give us a call. Phone number is 877-646-5347. Our phone lines are always open, and we're happy to answer any of your questions.